Rohr here with an early concise highlight on Friday, April 17th, 2015. It is currently 7 a.m. U.S. Central Time, and we're going to take a bit more of a look at the macro factors, but most important on the equities weakness this morning seems to be some further concerns in Europe and also some nervousness over some new Chinese trading restrictions. So what does all this mean to the markets? Well, it's very interesting that weakness we mentioned, we bothered to mention the weakness right away because the S&P 500 is off 14 at 2,086, and it's been down to a low of 2082. And that's very important because, of course, we mentioned yesterday when the market was lower that there was a fresh down break from up right near the highs, right up around the 2104 area, and the gap lower in the market left room to clean up, and it could have stalled even congestion at 2100, but no, it wanted to get back right to 2104, and a test started weakening. So even though it finished the day still slightly above 2100, this still feels like this stall out into low 2100 area. That's been going on since the lead contract set new highs back in February. We'll revisit all of that momentarily on the intermediate term charts. But for right now, what we've done is, instead of just breaking a minor channel, as of this morning, if this market is below 2091, it is first of all back below the gap higher out of Tuesday into Wednesday, first of all, and that's important because, of course, this was all the constructive central bank anticipation and fact, and it's also, as importantly, technically, that turned out, as the trend evolved across time, to be the upward channel, important upward channel level since the last lows back in the 2040 to 36 range. Your lower support goes back to the 2075 to 78 area. Very important once again because it's right where the market held on that pressure it took on Tuesday morning. Has developed a new interim level down around these lows into the 2067 area. But that is just an interim level below this trading area, with the more major support historically still down around that top of the January congestion range at 2060 to 58, and we'll see more of that on the intermediate term charts. One of the big things we're going to keep an eye on, of course, is whether the right now rather sedentary hourly and 30-minute MACDs end up heading down in a way that leave them out below their lower runaway bands once again. That pretty much does it for the short-term view of the S&P 500.